So basically, for those who are less familiar with real-world asset tokenization, just to give a brief overview before our panel discussion. So essentially, what is the RWA? So tokenized RWA, they are essentially the digital tokens which represent the physical and the traditional financial assets. So, well, for example, bonds, stocks, real estate, artwork, etc., etc. So broadly speaking, there are two types of RWA. So the most, being the physical assets and the traditional financial assets. So for the physical assets, it covers like the broad universe of real estate, artwork, well, for example, EV charging station, energy storage, etc. And for the traditional financial assets, this is more frequently talked about. For example, the bonds, stocks, private credit, the loan notes, investment funds, and well, digitized money like the tokenized deposits, central bank digital currency. The most so what has been most discussed recently. So broadly speaking, there are two types of RWAs. Okay, cool. So this just gives us an overview of what is the universe of RWA. So our guest panelists, welcome back to your seat. Okay, cool. Let's get started. So basically, can you just share some of your experiences for the successful tokenized RWAs and what lessons you have learned from those use cases? So maybe we start from who volunteer?
I don't mind. Sure. Hi everyone. So there are twofold examples here. One would be from the broader market. And in the broader market, we can see a lot more institutional involvement further and further. Although it's not incredibly publicized, it's still there if you find it. Like, for example, German-based company Siemens, if you've ever heard of them, they issued a $63 million bond, and they tokenized that. Then you have the MAS in Singapore, the regulator, who they themselves have also put together, a project themselves where they're basically, it's a consortium of different investors and a consortium of different banks and different big institutional players that are coming together and tokenizing Singapore bonds, tokenizing Japanese bonds, and even Singapore dollar in Singapore, and Japanese dollar as well. That's from the broader market perspective. And I think one of the lessons that we can learn from that is there is demand for this, and the institutional market, even before allocating into crypto in and of itself, is exploring what they know first. And what they know first are these types of products, as was on the screen before, right? The more traditional products, and how you apply blockchain to make that more efficient, more transparent, is obviously something that they're pursuing. Now, from my own personal life, I was at a company it used to be called Diginex, and it eventually rebranded to Equinix after they listed on the NASDAQ. But my job there was to basically structure a bunch of different deals around asset tokenization. And this was probably between the years of 2018 to 2019. And what we did was, because my real TradFi background is private equity venture capital, we went after a bunch of these venture capital funds and real estate funds. And what we did was we applied a blockchain layer, and obviously it had to be end-to-end. We had to have the setup in BVI or in Cayman Islands, wherever you need it to be, and then all the way into the issuing platform and where that needed to be located, and then all the way into the distribution channel. And what we were able to do at that time, and I'm sure this issue still persists today, is be able to have the structure, tokenize it, fractionalize it, issue it. But the issue that we really faced was at the end of it, A, we had regulatory question marks, and B, because we were tokenizing such big investment amounts from venture capital portfolios, no one wanted to buy it because no one was ready to custody it. Anyone that's going to put $50 million into a tokenized venture capital portfolio, it's an institution, right, generally speaking. And so if you're trying to repurpose that, there's a huge issue with buyers at the other end of it. You can accomplish everything from A, but you're not going to hit Z as a result of the fact that regulatory framework is unclear, as a result of the fact that there's no one really that can custody it in a proper, suitable way. And yeah, I think I've been rambling for a while, so I'll give it to my colleagues.
Yeah, sure. I can share some other practical things on which I've worked as well. We did a project financing by way of a fixed yield tokenized bond. And I think it was a good sort of explanation of the sort of benefits and also the limitations of smart contracts. So we, on one hand, it was a good thing because it was smart contracts would allow automated payments and sort of a lot of the company secretarial actions to be automated, sort of disseminating information, KYC and that sort of thing. But then we found that, the client had originally come to us saying, oh, we want everything to be done by way of a smart contract. And then we found that you can't do that. For something like a fixed yield debt, you obviously can because it was a quarterly payment. So every quarter you're being paid the same amount of money no matter what. But then there are certain things that it can't do. In a legal contract, you look at concepts such as reasonableness or the ordinary meaning of something. And if it's an if-then function, you obviously can't do that. And for things like dividends, where it may depend on the underlying business circumstances or market needs or things like that, obviously a smart contract can't take that into account. So you still need a human. So it works well when it's a fixed yield thing, when it's an if-then, come hell or high water, this is what's going to happen. But if there's anything that requires human intervention, you still need a human somewhere.
Yeah, thanks, Ralph, and also for Jonathan. Basically, what the perspective I'm going to represent would be in Web2, and that's with the global investment banks and also the pension funds that we serve. And in terms of successful examples, I think there are a lot of internal trials that have been done. For example, one of the leading investment banks, they already tokenized their whiskey and also the artwork. And then in terms of even for my previous life, so we've also done tokenization trials, pilot projects in terms of infrastructure funds, which is one of our signature products. And then I'll just go on to compare where we are now, and also where we have been in 2018 and before. And then my conclusion is going to be that we are at the right juncture right now. In terms of the ducks are sitting very well together compared to where we were before. So in terms of how the ducks are aligned, I would say that number one, regulations, and also number two, in terms of technology infrastructure, and also number three will be in terms of the whole ecosystem. So if we've all played a game before when we were still in MS-DOS or Windows 3.1, that was the game of pipes, right? Imagine a green fluid going from one point A to point B. You needed the pipes to go through in order for the the green fluid to go through, right? So right now we have the regulatory framework, and I think STO by far we are doing the best. And also the second would be in terms of all the custody. So if I just gather all the intelligence from my sell-side colleagues and also from buy-side investors, so we already have State Street, we already have Julius Baer, we already have HSBC doing a lot of custody work. And the third thing will be related to stable coins as well. So we see that in terms of going on-ramp and off-ramp, so that's very well as well. So I would say that I'm going to have this caveat the whole thing, and that is something for that we need to work on. That'll be in terms of secondary trading. Because what we see is, if we look at digital asset exchanges, Hashchain being the most prominent, is that we're missing this trading venue in which my feel around exchanges is that we're going to go through a round of consolidation. Imagine for equity capital markets, so they're national stock exchanges, which kind of have a regulatory moat around them. So all the liquidity goes around that. But however, for digital assets, even in Hong Kong, so we have like 20-something applying for licenses. Obviously, right now, there are 2 who are licensed, but very likely we're going to see the floodgates open. So my perspective around that is we need to see a consolidation, and that's when buy-side investors will go around one trading venue or a few trading venues, and that's where we see a lower liquidity risk premium.
Okay, cool. Thanks for the insight for sharing. So I think basically here I just summarize the key requirements. Maybe also it also echoes to the practical use cases our panelists have just shared. So basically, alongside the value chain of RWA and the entire ecosystem, so there were some key requirements and challenges for all the players. So I think first thing first might be just the reliable on-chain anchoring of the off-chain assets. How do you do fair valuation and the risk management? And secondly, it's essentially the regulatory compliance. So for example, the investor KYC, AML, and the privacy preservation. And thirdly, the security, so which we discussed previously. So the infrastructure for digital asset custody and the entire secured token issuance, lifecycle management, and cross-chain transactions, et cetera. And the last but not least, is the liquidity, the secondary market liquidity. So once we have this tokenized RWA issued, so how do we generate secondary market liquidity to make it more accessible to investors, and how the investors would be able to perform trades and settlement for those RWAs. So so basically this gives us an overview of the current state and the use cases in RWA. But if we address like a broader universe, so what do you think? What type of assets are most suitable for tokenization? Maybe we start from Esme.
Yeah, thanks. That's a very good question, because just to couch it with my overall view, right? So what I believe is that right now, or maybe 3 years ago, so the sell side is running ahead of the buy side when it comes to tokenized assets, i.e. there is more sell side supply as opposed to buy side demand around tokenized assets 3 years ago. And then right now at this juncture, what we're seeing is that there's a lot of buy side demand around it, especially around your offerings and also Hashkey's tokenized products. So I would say that how I answer this question will be related to the type of investors, and then I will follow on with the asset classes. In terms of the type of investors, I think number one would be sovereign wealth funds, obviously, because they prefer something that's more secure, right? And the second would be hedge funds, interestingly, because they want to go in and out of positions very quickly. And then I think tokenization, given the high liquidity, it also checks that box. And in terms of the third point, it will be around retail. The way we have looked at tokenization would be it's a B2B2C solution, right? Given that the whole VASP framework around digital assets will be for more retail to be involved, so the whole ethos around tokenization, whether it is for fragmentalization and whether it's for higher security and also regulatory compliance, I think it checks that box. And in terms of assets, so I would say commodities, obviously in terms of gold, which is all commodities, bonds, which we're already seeing, and the third would be on the other end of the continuum, which would be fine art and also for wine. And also for illiquid assets, which we've been working a lot with, would be in terms of infrastructure and solar panels.
Okay, cool. Thanks for sharing from a demand-driven perspective for the RWA tokenization. So, Jonathan, Ralph, do you want to share some other perspectives? For example,
sure.
From exchange perspective and from a digital asset native platform perspective.
Yeah, I mean, a lot of the clients that we've had have almost been self-selecting in that it's really been asset owners who are holding high-value illiquid assets that don't have an obvious liquid market. For example, if you want to buy stocks, you can go to the Hong Kong Stock Exchange, New York Stock Exchange, London Stock Exchange, and so on. If you want to buy art, you have to go to Sotheby's or Christie's, but you can't buy a fraction of that. And I had a client one day who said, I own a $70 million US Mark Rothko painting, right? So obviously the number of people who have $70 million that they want to spend in one go is small, right? But he said, if I could split that up, if I can put that in a vehicle and fractionalize that, and his model is to rent out paintings to places around Hong Kong, right? It's like a corporate art dealer. So the number of people who would want to get exposure to that and get a rental income stream would be quite high if he said, you can own 1/70 millionth of that, and you can have a future income entitlement, right? So things like that are quite attractive. Likewise, if you, yes? Yeah, sure, yeah. Go for it. Yeah. Yeah, that's a very specific question. I mean, I can't speak for the other two, but at Hashkey we do, right? Because not to talk our own book, but as Esme said, we're one of Hong Kong's 2 licensed exchanges. So we offer brokerage services, we offer exchange, we offer custody, and so on. So if there's an asset that you want to fractionalize, you can package that in such a way that you can distribute that to other people. So I think the question is not really who is the issuer; it's more who is your target market. Because then you need to think about, okay, anyone can sort of fractionalize anything, so that the law is not sort of focused on the issuer so much as the token holder, right? So is it a complex product? Does it have to be held by professional investors? What's the disclosure you need?
Right, that's one question. Say if I were to fractionalize, my family population,
Yeah.
security,
Yeah.
Lloyd is not issuing securities, and they're going to lock me up. But if you go through a platform that's already regulated,
Yeah, that's right. Yeah, that's right.
Yeah.
Sure, yeah.
Okay, thanks for the question. And I think we have a Q&A session at the end of the discussion. We can definitely discuss more on the art tokenization and also like the third-party appraisal and what is the best platform for that. Okay, thank you. And let's refocus on the panel for now.
No, it was a good question. Very on topic. Yeah, and so just to Esme's point, when she was mentioning the folks that are interested in it, i.e. sovereign wealth funds, hedge funds, and retail, I'd like to slip another one in there and actually kind of lean into what you were saying, whereby family offices in and of themselves, particularly with illiquid assets such as, for example, art. But I mean, I come from a VC background, so I heavily focus on that, and VC portfolios. And not only VC portfolios, but private equity portfolios as well. And real estate as well, right? I mean, the yield that you can get from real estate by owning a fraction of it, that's quantifiable. But the thing that really it opens a much broader market for particularly, like, for example, let's say the Blackstones or the KKRs, the big investment managers, private investment managers of the world. It opens up an entire new and broad landscape if the family offices that were previously being blocked by a 10 million minimum investment size can enter at a much lower rate and can exit whenever they want, because generally these family offices tend to have 10 million to put in, but that's a significant part of their portfolio that they're actually allocating, and it's a 7 to 15 year lockup period that they can't touch it. And so as a result of that fact, they tend to pull away and they don't actually tend to commit to it, which is absolutely reasonable to them. What if family goes through crisis? How can you withdraw it? And a lot of these guys go into hedge funds as well, but that's a different point. Yeah, I think there are tons and tons of things, and I think as this industry, I think there's another question that addresses this further down the panel, but I think we're going to see a lot more asset classes open up, and the breadth and the depth of the space, I think, will become a lot more robust as we continue.
Okay, cool. Just adding to that, so the current what is mostly discussed RWA is essentially the tokenized financial securities. But as Ralph has just said, there is the broader universe, which actually connects the real economy to the on-chain economy. So basically, on top of the most commonly discussed artwork, real estate, etc., there's also like other opportunities. For example, to really connect the physical assets to really provide on-chain return generated by the real economy. For example, what Ant has been practicing is utilizing blockchain to improve the efficiencies in the renewable energy sector. So what we are aiming at is essentially, to provide real returns from the real economy. For example, like the cash flows generated from leasing solar panels, the cash flow from the EV charging stations, etc. So basically, this just provides another. So we also believe this is another different perspective for like a different group of real-world assets to be tokenized and really provide the on-chain return to the real economy. Okay, cool. So thanks very much for sharing the insights on the assets which are suitable to be tokenized. And well, in particular, what do you think this kind of RWA would create for the emerging market and in developing economies in particular?
I mean, since you brought up art, I'll use art as an example. Going back to that art collector, I mean, if you ask him what's the biggest pain point in your business, he'd say fraud, right? As in, he doesn't know if you come to him and say this is a 17th century Rembrandt, right? He's got to get that checked. He's got to essentially get a human to verify that. Now, yeah, exactly, and you can still be fooled because at the end of the day, it's a human. Humans make mistakes and so on, right? And there's no record that it went from Esme to Jonathan to Raf to Daisy or who owned it, was the money dirty and so on and so forth. If you have an immutable record that says it was definitely owned by this person and that person, and there's no dispute, I think that's an incredibly powerful thing. And I mean, if anyone's bought and sold land in Hong Kong, you would have seen there's a chain of title which you can only prove by paper deeds, which is incredibly annoying. Anyone who's done that has had to actually look at paper, and conveyancers have stacks and stacks of paper. And if it's lost or it's damaged or anything like that, that's where you have disputes. And if you have a third world market or an emerging market that doesn't necessarily have like a trusted regulatory regime, that's when I think you can have blockchain bringing a lot of benefit.
Yeah, I think to Jonathan's point, so provenance is a very good perspective to look at it. And just to give you a background, so previously I was actually working as a partner with Alibaba and also with another tech company. That was in 2018. At that time, we were doing a smart supply chain for their e-commerce. And then the result was that because for a lot of different products, for example, even whether it's beef, you need to make sure that it's authentic. And I think that's exactly what Jonathan touched on. And the second thing, because coming from a financial background and also from more of a Web2 TradFi background, I think what's really important here would be cost efficiency. If you look against the entire macro backdrop, so I think right now it's less about returns maximization, more about cost efficiency. And that's where exactly blockchain will come into play, and also tokenization and liquidity.
I think about emerging markets a fair bit. I don't know if you can tell, I'm from one. But, well, we hope it's emerging. We don't know yet. Ultimately, we have to think about what the issues from an emerging market perspective is, right, or what they are. They run high government deficits, there's rampant corruption, and as a result of those two and a multitude of other factors, there are predatory and very, very high financing costs associated with that, right? Going into the market, they take loans with very, very high interest rates. So I'm speaking specifically with respect to infrastructure projects. Their infrastructure suffers as a result of all of these factors, and I think if you open up the market to a much broader audience, I'm not saying it will 100% fix it, but But by tokenizing some of these maybe infrastructure deals, you're able to possibly lower the cost of financing as a result of the fact that you can encode in your smart contract, for example, automated auditing, for example, right? There is provenance as well as to the funds, etc. And I do view it though as kind of a chicken and egg issue, because you need to fund infrastructure, but do they have existing technological infrastructure to actually support the funding of said infrastructure, right? And so it then becomes a loop and a chicken and an egg issue, and who's going to implement that, and that's just kind of how I think about that. Does that make any sense? Yeah. Oh wow, I'm usually at 98 or something.
Okay, cool. Thanks for the excellent sharing. Okay, cool. I think now we have a good overview of the current landscape. Let's just move on to the future prospects. So what are the notable trends in this space in 2024 and beyond that, in your view? So maybe we start from Jonathan?
I think I probably speak for the other two. I think we have agreed before this that deep in decentralized physical infrastructure networks is going to be a major trend, which sort of speaks to the point Raf was making about being able to crowdfund infrastructure. And I've made this point before. Essentially, if you want to build infrastructure now, it's typically only governments that have the deep pockets and the patience to be able to build something at such a large scale in such a short time. Or you have, deep-pocketed investors, very small consortia, and often, like they will charge tolls. They'll have their interests not necessarily aligned with yours. The value of being able to crowdfund infrastructure via tokens is you can have communities that are stakeholders in infrastructure doing things for themselves, and that's all traceable, and it can be tradable. And I think that's quite an attractive use case for tokenization that I think we'll see more of in 2024.
Yeah, I would say that 2024 is a year for tokenization. And the reason I say that was, first I'll start on the global standpoint. Obviously for EU, we have MiCA. And then for Korea, we also have a new tokenization regime. We are seeing a consortium of many Korean banks just rushing into that. And then just this week, so we have a institutional digital asset conference. Maybe it's a bit more boring than GameFi, right? But the thing is, so we had a Singapore edition last quarter. This quarter will be Hong Kong. And then what we're seeing is that the key theme of these two quarters has been tokenization, right? So I think that is the key buzzword. And the second thing is because there's a lot of discussions around just cost cutting and also efficiency. So I think tokenization exactly checks the box here. And the third thing I'd like to mention is tying back to my first point around the whole ecosystem. So given that in the beginning of this year, we're already seeing a lot of ETS, spot ETS being granted. So that means that, for example, a previous bank became an AP of BlackRock's ETF, spot Bitcoin ETF. So we're seeing that a lot of banks are basically rushing in order to sell the entire ecosystem, whether it's all the way from the beginning, it's just client onboarding, KYC, and then afterwards post-trade, there'll be settlement and also custody. So I think that's already being built up, and that would significantly reduce the cost and also the friction that will be involved. So I think the key thing is that this year is the year after so many years of crying wolf.
Yeah, so I'm just going to zoom out for a bit more of a macro perspective here in terms of just trends, and I think trends-wise, we've already seen a mass proliferation. There are tons and tons of these, for example, T-bill providers coming to the market, tokenized T-bills. I think we're going to see a continued proliferation, though I do think the interesting thing will be there will be an expansion in what asset classes are offered into the market. I do think we're going to see a lot more oracles, i.e. being the data feed between the off-chain and on-chain world. And how that feeds into each other. And I also do think that we will see a lot more private blockchains, because I think a lot more institutions are going to come in and start to do this. I don't think that we're going to see a lot of we will see a lot of participation on public blockchains, but I don't think institutions will go onto public blockchains as a result of the fact that it's really tough given the regulatory framework at the moment, and given the fact that frankly speaking, there's just too much counterparty risk for a bank to actually take versus issuing their own private blockchain. So I think those are kind of the two trends on a much, much higher level than these two guys have just spoken about.
So I think the key thing is that, aggregating a lot of investor opinion, whether it's the, high touch funds, the hedge funds, or whether it's the long only funds, I would say that the key thing is that we haven't seen a tokenization project that is having very high alpha or very high returns. So as you can see right now, if you're an asset allocator, you can either invest in spot ETF, Bitcoin. You can see that it's going, just a J curve this year, right? So what is tokenized assets competing against? Number one, maybe US stocks like Nvidia, and the second would be maybe, Bitcoin, right? So I think if this year we're able to see a very high quality project that is going to generate a lot of returns for investors, I think that'll be a very powerful test case for the entire industry, and I'm bullish.
Okay, cool. Yeah, I cannot agree more. I definitely believe this industry is growing, and also, as the technology continue to advance and more asset classes being tokenized and the regulatory framework evolve, and we will definitely see a bigger market share for the entire industry. So. Yeah, but also we also have to bear in mind there are practical challenges in terms of the competing yield, in terms of the security, in terms of the regulatory framework to support the growth of RWA tokenization. So speaking of which, so how do we think the regulatory framework will evolve actually to support the growth of RWA tokenization?
Okay. Yeah, I think that it really depends on the jurisdictions themselves, and I think you're going to see the world probably split into two. On one hand, you're going to have places like Hong Kong that are already established financial centers, and they have strong rules of law, well understood legal frameworks, and so on. And you've seen in Hong Kong already, the SFC has this mantra of same business, same risks, same rules. And the reason why they do that is because there are a lot of investors, a lot of lawyers, a lot of bankers, accountants who come to Hong Kong because they understand how the system works. So that's one camp. The other camp, I think, is you'll see places like Dubai, which has set up VARA, the Virtual Assets Regulatory Authority, which is a blockchain-specific legal system. And the reason why they've done that is because Dubai doesn't have the same standing in the legal world, in that people don't generally have contracts governed by UAE law in the same way that they might choose New York law or English law or Hong Kong law. And so they've almost got the freedom to design a virtual asset specific system. That's not necessarily better or worse, it's just because they're looking at the realities of what their market is and who their sort of potential investors are going to be.
And which jurisdiction do you think is actually most advanced in terms of RWA tokenization, in terms of regulatory framework, investor protection, etc., etc.?
I don't know that there's any one front runner at the moment. I mean, Hong Kong. If you went back a couple of years, you'd probably say they're a little bit late to the party. But I think they've caught up in terms of actually giving us that regulatory clarity. It's funny because a lot of the jurisdictions that were previously seen as supposedly crypto-friendly are the jurisdictions where there have been, a lot of the big collapses. Because crypto-friendly doesn't necessarily mean it's a good place to do business, because you can be too lax in terms of having an approach that is, we don't have strong oversight and so on. That's not really good for investors. It's not good for issuers. It's ultimately not good for governments because you don't have that certainty. I mean, Hong Kong has decided to slot virtual assets into its existing regime, which has given people a lot more clarity. Previously, there wasn't that clarity. So I think, if anything, the sort of crypto winter and the collapses that have occurred has meant that there's been a sort of flight to quality and a flight to certainty. So I'm not banging Hong Kong's drum or any jurisdiction's drum, but the fact that if there are people that understand how a regime works inside and out, it means that people are more likely to go and do business there.
Thanks for the sharing.
I mean, what else can I say to that?
Thank Jonathan for the professional insight from a legal perspective.